Okay, great. Good morning, friends. Well, I welcome you all to the first lecture on income tax. It gives me immense pleasure, to interact with you all and especially on taxation. Today, what we are going to deal is the basic concepts relating to income tax, how the levy is charged, um, how the Income Tax Act plays a very crucial role in for the government exchequer. We have got a lecture to discuss on the basic concepts. What I'll try and do is take you through the basic concepts and the most crucial aspects of the first chapter of your income tax module. Well, friends, do you know how much is the government collecting in terms of taxes? Well, a whooping 20 lakh crores is what the central government collects by way of taxes. Almost 20 lakh crores. So it's almost 20 trillion rupees. 20 lakh crores is what they are collecting, out of which the share of the central government is roughly around 13 and a half lakh crores. And out of the 20 lakh crores, uh, approximately 10 and a half lakh crores would come from the income tax by way of collection done under the Income Tax Act. So just imagine, of the total tax collection, which is one of the primary sources for the central government, more than 50% comes by way of income taxes or the direct taxes. So certainly it is really very important to draft an income tax law or implement an income tax law in the most effective manner, because 51% of the revenue of the tax revenue for the government is coming from the Income Tax Act. Now, when you look at the data of income tax, you'll realize that of the 7 crore people who are filing their income tax returns, roughly only 21% of the people filing their returns end up paying taxes because of the basic exemption limit. What I mean to say is 79% people don't have an income above rupees 5 lakhs. So, uh, of the data that was provided onto the income tax website for the assessment year 18-19, the 5 crore persons who filed income tax return, only 1.3 crore people indeed ended up paying taxes. So roughly, of the total population that we have in the country, now only 1.5 crore people are paying taxes, and they still contribute a substantial amount by way of income tax. When it comes down to indirect taxes, though, indirect taxes are to be paid, are to be borne by everybody, right? So in a big small way, you are pay you every person residing in the country end up paying indirect taxes in some form or another. Even the poorest of the poor is paying some part of their income as indirect taxes, while a poor person goes and something like a small biscuit packet, if he goes and buys a Parle, well, he has to pay income indirect tax in form of GST on that small biscuit pack. However, as far as the direct taxes are concerned, well, the direct incidence is only on those people who are capable of paying taxes. So direct tax, as far as the Indian context is concerned, where the disparities are huge, direct taxes play a very important role for the government, in helping them collect taxes and collect taxes with all fairness and equity. Now, every levy of every tax is should have some authority, and uh, if I give you an option that you may or may not pay taxes, well, what are you going to do? You're not going to pay taxes, isn't it? Just because you are compelled to, it is mandatory on you to pay taxes, you end up paying taxes. Now, Where does the power come from? Where does the power emanate from? Well, the power comes from Constitution of India. Understand, friends, the power to tax is the power to destroy. If there are, there have been instances where a large sum, a large percentage of tax is levied, and there is an outcry from the public, because any exorbitant tax would only lead to, destruction. And therefore the power to tax should be exercised very, very cautiously. And therefore it is the Constitution of India, precisely the article 265, which lays down the rule, and the rule is no taxes shall be levied or collected by except by authority of law. So always, there has to be some authority of law uh, by virtue of which taxes should be levied, because taxes by itself, there is no consideration flowing in respect of taxes, no direct consideration flowing in respect of taxes. And therefore it has to be done under an authority of law. So here you have the authority of law, and that is what is mandated by article 265. Now, accordingly, both the levy, see, how does it read? It says no taxes shall be levied or collected. So it is not just the levy of tax, but it is also the collection of tax. Levy and collection are both different. So if there is a power to levy tax, and if there is not a power to collect it, nobody is going to pay taxes. Therefore, you have got both the levy of the tax as well as the collection of the tax, and that could be done only and only under an authority of a law. By virtue of which, you have the Income Tax Act in place, which is the law as far as collection of taxes on income. How does the power go in the hands of the central government? Why the state governments don't tax income tax on the citizens or the residents in that particular state? Well, because the power to levy taxes on income is provided in the union list. So it is the union list of the seventh schedule, the list one of the seventh schedule, which empowers only the parliament to legislate, uh, act in respect of taxes on income. Let me show you the entry number 82 of the union list, which provides power to the parliament to make laws on taxes on income other than. So it says other than agriculture. So it's the taxes on income other than the agricultural income, which is going to be subject matter of the Income Tax Act by virtue of entry 82 of the union list. Now, state governments have also got powers to legislate certain laws. Now, those powers are enshrined in list 2 of the 7th schedule, which we call as the state list. And there is another list 3, which is the concurrent list. That is where both the central government and the state government have the power to legislate certain laws. So as far as the concurrent list goes, it is mostly the law and order, which is both the state as well as the union or the central government subject. Whereas, power to levy income tax is exclusively with the central government. Power to levy tax on agricultural income is with the state government and not the central government. And therefore, everybody of you are aware that agricultural income is exempt. The reason is because it is the state government which can tax it and not the union government or the central government. Now, coming to the Income Tax Act, which gets the power from the Constitution of India, and subsequently Income Tax Act 1961 came into force with effect from 1st of April 1962. And prior to this also, there were always, different Income Tax Act. One of the very, just the predecessor act was Income Tax Act 1922, which had undergone a lot of amendments, and therefore it was found suitable that a new act itself comes into play. Therefore, Income Tax Act 1961 was formulated. And when you talk of the income tax law, it is not just the Income Tax Act. In fact, there are 5 components to it. So One very essential component is the Income Tax Act. Yes, Income Tax Act remains to be the primary document, or as I call it, Bhagavad Gita of the income tax law is the Income Tax Act 1961. Uh, but apart from the Income Tax Act, there are another other four sources of the income tax law. One is the income tax rules. So we've got rules. Then we also have the Annual Finance Act, which is the source of income tax law. Every year, the finance minister of the country brings in the finance bill in the parliament, which is subsequently, becomes the act. And that finance act brings in a change in the income tax law in India, right? So the finance act, we've got the income tax rules, we've got the finance act. We also have the circulars, different circulars, which comes from the CBDT, the Central Board of Direct Taxes, which is the administration, which ensures administration of income tax law in the country. That is the Central Board of Direct Taxes. Now, Central Board of Direct Taxes issues various circulars and notification. Now, those circulars and notification are also part of the income tax law, very important for administration of income tax law in the country. Therefore, we have, apart from the Income Tax Act, we have got income tax rules, we've got the Finance Act, we've got circulars, notification issued by the Central Board of Direct Taxes, and the very important case laws, right? So it's the case laws. You have got various, income tax department is the biggest litigator in the country. So you've got a lot of dispute that is going on as far as the Income Tax Act is concerned across the country. And therefore, whatever decisions which are given by different high courts and the Supreme Court would, become the law of the land. The decisions of the Supreme Court would become law of the land. The decisions given rendered by the high courts, it would be applicable to that jurisdictional state. So wherever the high court is located. So if let's say the Bombay High Court, the decision of the Bombay High Court would be applicable for the entire state of Maharashtra. So we've got these four sources of income tax law apart from the very important Income Tax Act. Let me just take you through each of the source now. Now, when you look at the Income Tax Act, it applies to the whole of the country. It came into force with effect from 1st of April 1962. The first assessment year to which Income Tax Act 1961 was applicable was AY 62-63, 1962-63, and it contains section 1 to section 298. However, that does not mean there are only 298 sections. Well, there are a lot of different sections under the Income Tax Act. We have possibly used all the alphabets, where the alphabets, when all the 26 alphabets are over, we have started with A, double B, AB. We've got plethora of sections under the Income Tax Act. So it's a huge bulky legislature that is in place. Thereafter, chapter 1 to chapter XX triple I, that is 23. So we've got 23 chapters in the Act, which contain section starting from 1 to section 298, and there are 14 schedules. Now, this Act undergoes a change by virtue of the Finance Act. The Finance Act brings in hundreds of amendments every year to the Income Tax Act. And, when you look at the Act, it has undergone a lot of change for a lot of time now. And to quote the very famous Nanibai Palkiwala, the very famous tax jurist of the country, late Nanibai Palkiwala, he suggested that Income Tax Act is a national disgrace. Why? The reason he said is that it has undergone more than 6,000 amendments. When you talk of the Constitution of India, it has undergone only 104 amendments since inception. When you talk of Income Tax Act, it has undergone 6,000 amendments. And when I look at it, I feel that it is Uh, Although it might have undergone a lot of amendments, but then uh, having regards to the nature of our country, the disparities of the country, the length and the breadth of the country. Every finance minister tries something new, and therefore the Income Tax Act naturally undergoes a lot of changes every year. Now, when you talk of income tax rules are used for administration of direct taxes. So whatever provisions are contained in the act, you have got the rules which would be helpful in application of the provisions of the act. So rules are incidental or ancillary to the act. Rules cannot take away the authority of the act. So whatever is given in the act would be final. Rules would only help administer that act. So that is income tax rules. Now, the formulation of rule is with the Central Board of Direct Taxes. So the CBDT is going to formulate rules to administer the act. Then you have the Finance Act. Every year you have a finance bill which is moved into the parliament and which is subsequently turned into an act. And the Finance Act not only amends the Income Tax Act, but what it also does is it gives you the rates of income tax. So whatever the rates that you know about the Income Tax Act, the taxes, the rates of taxes. So like 2.5 lakh rupees of exemption. Where does it come from? It comes from the Part One of Schedule One of the Finance Act. So it is the Schedule One of the Finance Act which gives the rates of the income tax. So part one would give you the rate for assessment year. Now, when we talk of Finance Act 2020, it would give away the rates for the assessment year 2020 and 2021. So assessment year 2020-21, the rates are given by Finance Act of 2020. Then, apart from that, it also gives the rates of TDS for the financial year 2021. So, see, the final rates for AY 2021 is given by Part 1 of Finance Act 2020. The Part 2 gives the rates of TDS for the financial year 2021. Right? So, different rates of TDS have been prescribed for different type of income. We'll come to it when we deal with the provisions relating to TDS. Similarly, it also prescribes rates for TDS on salary and advance tax. Now that is provided, the rates of TDS on salary and advance tax is provided in Part 3 of the Schedule 1 of the Finance Act. So we've got the rates of advance tax, we've got the rates of TDS, and we've got the rates applicable to that assessment year, in Part 1, Part 2, and Part 3 of the Finance Act. Similarly, the Part 4, the fourth part of the Finance Act also provides for the computation of net agricultural income. Now, you would say that, there is no power to the central government to tax net agricultural income. So why do I need to compute net agricultural income? Well, agricultural income got to be computed for rate purposes. There is a very interesting manner in which the income tax is computed for a person who is in receipt of agricultural income, and apart from agricultural income, he also receives others income from other sources. So like salary or business profession, if he is having income from other sources as well as agricultural income, it only changes the manner in which the tax is computed. So Part 4 is going to provide for computation of net agricultural income. There are 11 rules. We'll see this when we deal with exempt income. But for the timing, understand that there are three parts to the Schedule 1. The first part deals with the rates for assessment year 2021. The second part deals with the rates of TDS for financial year 2021. So that means assessment year 21-22. This is where assessment year 21-22 TDS would be deducted by the assessee in accordance with the rates prescribed in Part 2. And the Part 3 is going to provide you with the rates of salary and advance tax, for the financial year 2021. That is assessment year 21-22. So now once the rates are in place, the subsequent, see what happens here is the rate of advance tax provided in part 3 would become part 1. It would the part 3 of Finance Act 2020 would become part 1 of Finance Act 2021, right? So like this part 1 of assessment year 2021 is part 3 of Finance Act 2019, right? So this is the three parts of the Finance Act, the first schedule of the Finance Act. Apart from that, there are different circulars which are issued by the CBDT. Now, circulars and notifications are issued by CBDT to deal with specific problems. At times, there is some hardship to the assessee, and therefore, to deal with that specific situation, like let's say, for instance, the due dates of the uh, filing of the return of income. Now, we couldn't file return of income because of the lockdown, right? So immediately the CBDT, what they did is they extended the due date. Now, how that due date is extended? There is a problem in place. First, there should be a problem in place. And if at all there is a problem in place, the CBDT would relax the provision by way of an issue of a circular. So circular is going to deal with specific problem, and it would clarify the doubt regarding the scope and the meaning of certain provision. Now, this is, when you talk of a circular, it is going to give you the CBDT's perspective about a particular provision of the act. So it is not binding on the assessee, but once the circular is issued, once the CBDT finds that a particular provision got to be implemented in a particular way, it would be binding on the assessing officer. He would always have to follow that circular. So the circular issued by the CBDT would be binding on the assessing officer, but not the assessee. However, it acts as a very, it acts as a wonderful, what we say, uh, it gives you a direction as far as how the provision got to be implemented, or how the provision got to be interpreted. Thereafter, now circular, it also, so circular would give a specific direction to a particular provision, or it would clarify the scope of the provision, or it would relax the provision. However, the notification issued by central government would give the effective date of a particular provision. Sometimes what happens is an amendment is brought into the act, and the amendment is where the central government gives the power to the CBDT to make it effective from a particular date. Now, when it is such a case, it becomes effective from the date of issue of the notification. Similarly, notifications are also used to make or amend rules. So effective date under an act could be by way of a notification. Similarly, rules can be amended by way of a notification. Now, this notification would be binding on both the assessee as well as the department. So unlike circular, which is binding only on the department and not the assessee, notification would be binding on both the assessee as well as the department. Now, the last limb of the income tax law is the case laws. So we have got different appellate forums, and with the different appellate forums, whenever there is a dispute between the assessee and the department, there would be a decision that would come up. Now, Supreme Court decision is the law of the land. High Court decision would be applicable to the state jurisdiction. And however, let me clarify, at this stage itself, the decisions of the different courts are not applicable for the intermediate level. So we're not discussing case law throughout the lectures. What we are trying to do here is, I'm just dwelling upon you that case laws are a very important part of the entire income tax law. So as you go into finals, you will have to deal with the case laws, different case laws. But for the time being, these are the 5 components of the income tax law in India. So the Act, rules, Finance Act, circulars, notification, and the case laws. Now, let's move on to the very important charging provision. See what happens as far as every fiscal statute is concerned. For every fiscal statute, there should be some charging provision. If 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 at all any tax got to be collected, it got to be collected under authority of law. If if you do not have the authority of law, you cannot collect any tax. In order to provide such authority, there is a charging provision in every fiscal law. Every and Income Tax Act is not an exception. As far as the Income Tax Act is concerned, Section 4 of the Income Tax Act is the charging section. Now that Section 4 provides for the basis of levy and collection. So I'm talking of both levy as well as collection of tax. See, mere levy is not going to help. I've told you earlier. If taxes are levied, but if there is no power to the government to collect those taxes, well, nobody is going to pay. And therefore, the Section 4, the primary or the principal charging section under the Income Tax Act provides for both the levy and collection of the income tax in India. Now, it reads like this: where any central act enacts, so it does not, it refers to a different act. So income tax, the charging section of the Income Tax Act is referring to a different act of the central government. So where any central act enacts that income tax shall be charged for any assessment year. So income tax should be charged for an assessment year, right? So every time, whenever income tax is going to be charged, it is going to be charged for an assessment year. So income tax shall be charged for any assessment year at any rates. It shall be charged for that year in accordance with and subject to the provisions of this act. So the rates of the income tax are provided into a central act. However, it would be charged in accordance with this act. So the central act would provide rates and it would be levied according to the provisions of the Income Tax Act 1961. Now, in respect of the total income of the previous year of every person. So tax is going to be charged on the total income. See how the charging machinery is very important. Tax is to be charged on the total income. So if an assessee doesn't have any income, well, nothing could be charged to tax. So tax is to be charged on total income of the previous year of every person, right? At rates prescribed by the Finance Act for the assessment year, right? So we get the scheme of the act. The scheme of the act is tax is to be charged on total income of the previous year of every person on the total income at the rates prescribed under the Finance Act for the assessment year. Now, therefore, the terms like assessment year, previous year, or a person to what is income would be very important. If you were to charge tax correctly, you should understand each of the terms used into the charging section, right? We come to it in a short while. But thereafter, what we see is after this section 4, subsection 1, we have a proviso that is added, provided that whereby virtue of any provision of this act, income tax is to be charged in respect of income of a period other than previous year, income tax shall be charged accordingly. So now understand what does the proviso do. So I've given you section 4, and here we do have a subsection, right? And we have a proviso, right? Now what the proviso does, proviso here is acting as an exception to the fundamental rule. Now the fundamental rule is that income of the previous year is going to be taxed in the assessment year. However, the first proviso provides that income of the previous year can be taxed in that particular year if there is any specific provision to do such a thing, tax the income of the previous year in the previous year itself. So this proviso provides for an exception. Now, by virtue of this proviso, we have a couple of sections whereby the assessing officer has got a right to tax the income of the previous year in the previous year itself. We come to those five instances where the assessing officer can do it. Let's go to subsection 2. So subsection 1 creates the charge or the levy of income tax. Subsection 2 provides for collection of income tax. In respect of income chargeable under subsection 1, it says in respect of income chargeable under subsection 1, income tax shall be deducted at source or paid in advance. Right? So it would be deducted at source or paid in advance entirely by the assessee. So it is very important that you also have a collection machinery along with the charging section, right? So you have the levy provided by section 4 subsection 1, and you have the subsection 2 which provides for the collection of taxes. We've we did see that the rates for the assessment year are applied for the income which is earned in the previous year of every person. Now, what is assessment year? Assessment year is defined under section 2 into bracket 9. Right now, 2 clause 9 says assessment year means. So it means the period of 12 months commencing on first day of April every year. It means a period of 12 months starting from 1st of April. So 12 months would always end on 31st of March. When it starts from 1st of April every year, it would end on 31st of March. So like 1st of April 2021, it would end on 31st of March 2022. So assessment year 21-22. Now, as far as the previous year is concerned, it is defined under section 3 of the Act. For the purposes of the Act, previous year means financial year immediately preceding the assessment year. Now, thankfully, we don't have both of them interdependent on each other. Assessment year is clearly defined as the year starting from 1st of April every year. Previous year, in case of previous year, they say it means the financial year immediately preceding the assessment year. However, there is a proviso. Now, this proviso again provides for an exception. What are the exceptions? So, in case of business or profession which is newly set up, a new business which is set up, or a source of income which comes into existence in the said financial year, a new source of income, right? In both the cases, the previous year shall be the period beginning with the date of setting up of the business or profession. So it is the date. So sometimes what can happen? A person sets up a new business. Let's say he sets it up on 30th of March, right? So now in his case, the previous year would not start from 1st of April, but it would start from 30th of March and end on 31st of March of that year in which the business have commenced. So, but for subsequently, once the business is commenced, subsequently, every previous year would be that of 12 months only. So it would start from 1st of April. The date of setting up of the business or profession, or the date on which the source of income newly comes into existence and ending with the said financial year, right? So do you get the assessment year and the previous year? So as far as the previous year, starting from 1st of April 2020 is concerned, when financial year starts from 1st of April 2020 and it would end on 31st of March 2021, right? So it would the financial year the financial year 2020 or the previous year 2020-21 would start from 1st of April 2020, end on 31st of March 2021, and the relevant assessment year would be starting from 1st of April 21 and end on 31st of March 22. Let's take up a few examples. So like here, let's take up a few questions. The rates of TDS for financial year 2020-21 are given in, we have just discussed the rates of um, the income tax as well as the TDS are prescribed in the Finance Act. We did see that into the Finance Act, we've got Schedule 1 of the Finance Act, which provides for three different parts. So we've got three parts of the Schedule 1, which provides for the rates of income tax and the rate of TDS and the rate of rates for the advance tax and the salary. So I would want you all to say how does it, the rate of TDS for financial year 2020 21 are given in part 1 of the Finance Act 2021 or part 2 of the Finance Act 2021, part 3 of the Finance Act 2020 or part 2 of the Finance Act 2020. Okay. Just leave it into the query section. Just leave your answer into the query section. All right. Chitra says it's B, that is part 2 of Finance Act 2021. Well, Chitra, no, it is not part 2 of the Finance Act 2021 because see, the Finance Act of 2021 would come in the month of February, right? So it is last month when the finance minister presented the Finance Bill 2021. Now it would come in force from the first day of April 2021, right? TDS is to be deducted in advance, right? So for the financial year 2021, the Finance Act 2020 or 2020 would be, prescribing the rates, and therefore it is not B, Chitra. Yes. So Vasudha and Nandi, option D. Mohammed Ali, no, it's not C. See, as far as the rates of TDS is concerned, it is provided in Part 2 of the Finance Act and not Part 3. Part 3 provides for TDS only in respect of salary and advance tax. So for all other practical purposes, it is the Part 2 of the Finance Act which prescribes rate for all other provisions. Not all other provisions. There are a few provisions for which rates have been prescribed under the Finance Act. In respect of some other provisions of TDS, the rates are prescribed in the Income Tax Act itself. So yes, the answer would be D in this case. It is not C. It is 2020. The Finance Act of 2020 in Part 2 of Schedule 1 prescribes the rate of TDS. Let's move on to the second MCQ. Normal rates of income tax are prescribed in the Income Tax Act, A, Income Tax Rules, B, C, Finance Act, or D, by way of a CBDT circular. Well, Karthik, you're right. The rates of TDS for financial year 2021 are given in Part 2 of the Finance Act 2020. Fantastic. Yes, Nandi, I'm receiving your answer. Drushti is asking what is the meaning of levy. See, the levy of income tax is the charge of the tax. When, see, not all income. So income that you earn in the, let's assume, you have got income which starts which you have earned on um, 1st of April uh, or 1st of April 2021. Rushti, you have earned income, let's say, on 1st of April 2021. Now, the levy of that tax would not be in the assessment year 2020-21. It would be in 21-22 assessment year, sorry, 22-23 when the levy would be there. So it is the charge of tax. When would be the income taxable? That is levy. Once the charge is frozen, only then can there be a collection. If a particular income is not chargeable to tax in a particular year, you cannot collect taxes. Do you get my point? So therefore, the difference between levy and collection is the levy happens at a particular time, and only subsequent to that there would be collection of tax. So yes, it is option C. A lot of you have answered it correctly. It is the Finance Act which provides for the normal rates of income tax. Income tax is the rates of income tax are provided in Part 1 and Part 3 of the Finance Act. No, the advanced tax rates are provided in Part 3, whereas the rates applicable for a particular assessment year are provided in Part 1 of the Finance Act. And therefore, it is the Finance Act. Then let's talk of this. Which of this is not a component of income tax law in India? Yes, can you tell me which of this, whether the decision of Supreme Court is part of the income tax law in the country? Yes, it is indeed the law of the land. Circular and notification, we did see it is one of the important components of the income tax law, because it gives you the departmental perspective or the perspective of the government of how they interpret a particular provision. Then you've got press note and the Finance Act. So Finance Act, we have already seen that it not only prescribes the rates of the income tax, but it also brings in amendment to the Income Tax Act, and therefore it is an important component of income tax law in the country, right? So what is remaining then? So you've got the press note. So sometimes, while solving the MCQ, you also can go by exception. Now, which of the entry in Schedule 7 grants the central government the power to levy income tax? So, we did discuss the 7th schedule of the Constitution of India, and which entry gives the power to the central government. So it is the entry number 82 of the union list, right, which gives you the power. So it is the entry number 82 which gives the power to the central government. And therefore the answer would be A in this case. Entry 82 of list 1, that is the union list, gives power to the central government to levy income tax other than the agricultural income, right? Let's move on to the last. Well, Mansha is asking, how do I identify whether a particular provision is a clause or a subsection? Well, I'll just share in a short while. When we see a particular clause, I'll just show you the distinction. But for the time being, understand here, Mansha, that um, here, as far as the section 4 is concerned, both subsection 1 and subsection 2 are dependent on each other. You could just realize here that this subsection 2 is dependent, or is going to change subsection 1, or is dependent on subsection 1. In respect of income chargeable under subsection 1, income tax shall be deducted. So you have to read the entire section 4 along with both the subsections. So they don't operate independently. They are dependent on each other. So whenever a particular provision is dependent on some other provision, it would be called as subsection. However, if there are if a particular section and there are different provisions to a particular section which operate independently, right? So they are not dependent on each other, which operates independently. They are called as clauses. We'll come to it in a short while. Yes, for the time being, yes, the MCQ here. Rishabha CA student started business on 13th of July 2020, right? And is following a policy to close the books on December 31st every year. So he has got a policy of closing the books on 31st of December. Now that can happen. Books can be closed on a particular date because let's assume here he's running a business with a foreign collaborator, and that foreign collaborator wants him to give away the details starting from 1st of January to 31st of December. Usually, in many countries, it is the calendar year, which is the financial year. It is only in India that you have 1st of April to 31st of March. So if that be so, still, as far as Income Tax Act is concerned, the previous year would always end on 31st of March 2021. So yes, Rishika, you're absolutely right. It is this B. The option B is the correct option. It would start, since it's a new business which have been started. The previous year would begin from the date of setting up of the business. We did see the proviso here, proviso to section 3, which says that the date of setting up of business would be the first day of the previous year in case of a new business. So since he has started a new business on 13th of July, the previous year would start from 13th of July and end on 31st of March 2021. So it is indeed B. So Rishika, you're right. Then let's move ahead. Now, while we dealt with the charging provision, we did see that there was a proviso wherein an exception was carved to the thumb rule that the income of the previous year is taxable in assessment year. The charging provision did give us a proviso whereby it suggested that by virtue of any provisions of this act, if income tax is to be charged in respect of a period other than the previous year, it can be taxed accordingly in accordance with the provision prescribed under the Income Tax Act. So we have got 5 instances of accelerated assessment, and the provisions are contained in section 172, 174, 174A, 175 and section 176 of the Act. Now understand, why would I, end up accelerating the assessment? As a thumb rule, always income of the previous year is taxable in the assessment year. But there are certain instances where what I need to do is I need to accelerate the assessment. I would do that only if I feel that if I delay the collection of taxes or the levy of tax, the person would not come back, or the person would run away, or I would lose the control over that particular person, right? Only in that case, I would accelerate the assessment. So it is like a normal businessman, if a normal businessman think from his perspective, if he's doing business and if he feels that the customer is not going to come back, what he'll say, you give me the money first and only then you go out of my shop, right? So I'll give you the goods only if you pay me the money. So similar is the case here. There are these 5 exceptions where the assessing officer is given the power to tax in the previous year itself. So the first section is section 172, shipping business of a non-resident. Now, the 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 very the very threshold condition here is that that it is the case of a non-resident. Only if the assessee is a non-resident, in that case, Section 172 can come into play. So if a person is not a non-resident, Section 172 would not come into play. And he is into a shipping business. So a non-resident carrying on shipping business and earning money in India out of the goods passenger, freight that he collects from, transportation of goods or passenger from an Indian port outside India, his income would be taxable in the country. So one, it should be a non-resident. Two, there should be a shipping business, and he should earn something from transportation of goods, passenger, etc., from that ship leaving any port in India. So if that be so, he would be allowed to leave India only after he pays tax on 7.5% of the freight that he collects from the Indian cargo. Right? Do you get my point? It is only and only if he pays tax on 7.5% of the freight would he be allowed to leave India. Because understand, very, very logical. This is fairly logical. If he leaves the country, and you don't collect tax from him while he's leaving the port, what, he'll never return back, and the tax administration could never collect the amount of tax on the freight that is collected from the country. And therefore they say that presumptive income is computed at the rate of 7.5% of the total freight collected from the Indian cargo, which could be in respect of goods, passenger, livestock, anything. Whatever freight is collected, 7.5% of that would be deemed to be the income, and tax would be collected from such non-resident leaving from any port in the country. I understand if he does not pay the tax, well, if he does not pay the tax, he would not get a custom clearance. So provision has been made that no port clearance would be granted to such a outbound ship unless and until the captain pays the amount of tax, or at least he should prove that satisfactory arrangement have been made for payment of taxes. So if the non-resident has got an agent in the country and he is going to subsequently pay the tax, and if the collector of customs is convinced that the agent is going to pay the tax on behalf of the non-resident, then probably he would give the clearance for the ship to go out of the country once it has made the arrangement for paying the taxes on 7.5% of the freight. Now 7.5% of the freight is the presumptive income, which the non-resident have to declare, and on that 7.5% he would have to pay the amount of taxes, right? He should also file a return within 30 days. So not only would he be required to pay the tax, he would also be required to file a return within 30 days after the ship has left the country. However, going out of the country, he has to pay the tax prior to moving out of the country. Similarly, so that was non-resident engaged in the shipping business. Now, apart from the non-resident, even if the resident are leaving the country, so whether it is non-resident or a resident who is leaving India with no present intention of returning back, if he has got no present intention of returning back, income up to the probable date of his departure would be taxed in the previous year itself. Right here also, the income of the previous year is taxable in the taxed in the previous year itself. Similar to that, anybody who is leaving the country and who has got income in the country, who has got no intention of returning back, would be taxed up to the probable date of departure in the year in which he is leaving the country. Right? Do you get this? Very, very fairly logical. If if at all a person is going out of the country, you are going to lose control over that particular person. And once you're going to lose control over that particular person, subsequently recovery will not happen. And therefore, provision have been made to empower the assessing officer to collect taxes on income up to the probable date of his departure from the country. Some people, what they do is they leave for employment outside the country. They're not going to come back to in India for a considerable future time. In such cases, powers have been given to assessing officer to assess their income immediately. Similarly, a person who a non-resident who have been in India for a long period of time and who's going to go out of India again. So a non-citizen of the country who's going to go out, he has got some income in the country. Before he goes back, before he's returning to his own country, well, we are going to tax his income in India. Then similarly, AOP, Association of Person, Body of Individual, artificial juridical person, formed for a particular event. There are certain bodies which are formed for a particular event. Let's say, there is uh, there is a concert, a musical concert, right? And a particular AOP is formed only for that musical concert. Now, once the concert is complete, the AOP would dissolve. Now, once it is dissolved, all the members would not be traceable, and therefore, whenever a particular association of person, body of individual is formed for a particular event or a particular purpose, and it is likely to be dissolved in the same year or in the next year, assessment could be done up to the date of dissolution. So I'll take a example here. I would indeed take some example, but for the timing, understand that wherever a short-term AOP is formed, right, for a small, for a particular purpose, like a concert, what would happen is it would get dissolved, and therefore it should be taxed at the earliest instance. So whenever the assessing officer comes to know of a particular AOP which is likely to be dissolved, he can tax it in the year in which it is going to be dissolved. So the income of that particular AOP up to the date of dissolution is going to be assessed in the previous year itself, and the assessing officer would not wait for the assessment year to start. Then similarly, person likely to transfer the property to avoid taxes. So like if the assessing officer comes to is in possession of an information that a particular person is likely to transfer, sell, dispose of, or part away any of his property with an objective of avoiding payment of tax liability, right? So if at all the objective is to avoid the tax liability, and by virtue of which he's selling off or disposing of his property, what he can do is he can assess up to the date of starting of the proceeding. He can suo motu start the proceeding and recover all the amount of taxes which that person on the income which that person has earned, not only out of the sale, charge, or transfer or disposal of the property, but also in respect of his other income, right? So it is acceleration of the process of assessment, because you never know, he'll be an absconder thereafter, right? He sells off everything and he goes out of the picture. Now where does the assessing officer go and find him? And therefore, when he's in front of the assessing officer, what I mean to say is front of assessing officer, whenever he's traceable, or whenever he's in the process of selling or disposing of all of the properties, the assessing officer would recover the taxes there and then. Then, in case of discontinued business, the assessing officer, like when what all the instances we saw was in where the assessee are likely to go outside the country, or they are going to shut down their operation, right? So when you look at section 172, it deals with non-resident who is going to go outside the country, right? Person leaving India, right? Similarly, dissolution of AOP, wherever the business is likely to be closed, right? The body is itself going to be dissolved. So similarly here, in case of discontinued business also, wherever the discontinuation happens, the assessing officer has got the right to assess the tax on income up to the date of such discontinuance. So whatever income has been earned up to the date of discontinuance would be taxed in the previous year itself. However, there is one difference between section 176 and the rest of the section, and that is the discretion of the assessing officer. Look at this, section 172, 174, 174A, and section 175. Here, the problem is serious. The person is either not going to come back, or the person is not going to be traced in India also, right? So he's selling off all his property, and thereafter he probably would become absconder, and therefore for all the four earlier sections, there is no discretion to the assessing officer. He has to assess in the previous year. Once he is aware of the information, he would have to make the assessment up to the date of, either leaving outside the country, if he's leaving outside, leaving the country up to that date, or up to the date of dissolution, or up to the date of starting the proceeding. However, in case of discontinued business alone, if the assessing officer is of the opinion that the person is not likely to abscond, he may or may not, right? So there he has got a discretion. He may assess up to the date of discontinuance, or he may alternatively wait up until the assessment year to start. So he would let the previous year complete and only thereafter assess the income of the assessee. So that is section 176 in case of discontinued business. Well, there is a question from Vaishnavi. Vaishnavi, how is the assessing officer going to get all the information? Well, generally, such information is not readily available with the assessing officer. But then sometimes, people give information about other people to the assessing officer. So there is something called as a tax evasion petition, which is filed with the assessing officer. Or alternatively, what could happen is the assessing officer would be in possession of the history of the assessee, that the historically the assessee has not been paying taxes on time, or he's known to be a willful defaulter. In such cases, he is defaulted on bank loans, big, huge bank loans, wants to go outside the country. In such cases, accelerated assessment takes place. Now look at this. We'll just go to a few MCQs here um, and try and understand the concept. So like Singham, the income tax officer, finds that Mr. Raju has discontinued business on 30th of July 2020. Right now, the business have been discontinued on 30th of July 2020. Now, how does Singham would tax Mr. Raju? Whether he should tax him immediately in AY 2020 as per rates prescribed in Part 3 of the first schedule of Finance Act 2020, or whether he should wait and tax him in AY 21-22 as per Part 1 of the first schedule of Finance Act of 2021, or both. Can he do both of it, or whether it would be either A and B as per his discretion? There's a funny query. I'll not answer it. Ashok, I won't answer your query because I don't know how. So yes, we have got Vijay Shankar who says D, either A or B as per his discretion. We have Anirudh who says D. So yes, it is indeed D. In case of discontinued business alone, the officer, the assessing officer, has got the discretion. Either he can accelerate the process of assessment, or he can wait for the assessment year to start. Then, so we've got Chulbul, the AO, the assessing officer, while finalizing assessment of AY 1920, forms an opinion that Mr. Vijay would leave India permanently on 25th of December 2020. What could Chulbul do? Now look at this. Where does he get the information from that Chulbul is going to leave the country? Well, he's assessing, he's already doing his assessment for assessment year 1920. Right? He's already assessing his income. So financial year 1819 is already under assessment. Then you have got financial year 1920, right, for which he has already, his return is already due. Then you also have financial year starting from 1st of April 2020 to 25th of December 2020, in which he has earned some income in India, and he would leave the country on 25th of December 2020. Now Chulbul is aware of the fact that Vijay is going to go permanently. What could he do? Whether he could assess the income for assessment year 1920? The answer is yes, undoubtedly. He's already assessing the income of the year 1920. So he's going to do that. Whether he can assess the income for AY 2021? Well, yes, he can always assess the income of AY 2021 because financial year 1920 is already over by this time. In fact, his return is also due, and therefore he can assess the income of financial year 1920. However, the financial year starting from 1/4/2020 is not complete. But since Chulbul is aware of the fact that he's going to leave the country, he can accelerate the process of assessment, and therefore he would also assess the income of 1/4/2020 to 25th of December 2020, and therefore he can do all three of this, right? So all of the above. Answer is D. Wonderful. Yes. Shivangini, perfect. It's D. Shaurya, yes, it is D indeed. Aditi, correct. It is D. Sangeeta, where does option A come from? No, option A, yes, it is correct. But then, the more correct answer is D. So you have to go with a more accurate answer. All of them are correct. You have to go with the most accurate one. Now, while you think of the multiple choice question, you can divide multiple choice questions into two parts. One of them is like theoretical multiple choice question, and the two would be, problem based multiple choice question. Both of them are, both of them could become really dicey. The answers could look very similar, and therefore having a conceptual clarity is extremely important. With tax as a subject, um, when I think of tax as a subject, I feel that scoring 60 is not a difficult task at all. Most of the time, what could happen is, if you know the theory well, you can easily solve a practical problem. Unlike, something like an accounts or costing, where all of it, you would have solved hundreds of problems, but then you would have a problem out of the world, into the question paper. However, in case of taxation, that is not so. In case of taxation, mostly it is provision driven. The practical problems are mostly provision driven. If you know the provision well, you can easily solve practical problem as well as answer a theoretical question. So with tax particularly, I feel that it is one of the very easier subject to score 60. So um, just try and read the problem carefully. Once you read the problem carefully, you would know that what the answer is if you know the provision well. Let's move to the third question here. Now, there was an interesting query, and that query is AOP and BOI particular formed for a particular event. Isn't it equivalent to discontinued business? The answer is yes, Akanksha, you're right. It is almost similar to discontinued business. But in case of discontinued business, the entity remains. Only the business is discontinued, right? So Akanksha starts a business, shuts it off. Akanksha is still there, right? And therefore, discretion has been granted to the assessing officer. Whereas, what could happen in case of an AOP, it gets dissolved. The entity itself vanishes, right? And therefore, there's no discretion to the assessing officer. Look at this example here. I've taken care of your query with by way of a MCQ. Red Flakes is a AOP formed on 14th of November 2020, right? So X and Y formed an AOP on 14th of November 2020 for a limited purpose of a musical concert, right? They have formed it for a musical concert of a British band called as Hot Play, right? On so once the limited purpose is over, the concert is on 14th of Feb, right? I hope you understand the relevance of the day, right? The 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 concert is on 14th of Feb, and it is informed by the AOP to the AO that it would be dissolved after the concert. Now, since it is being dissolved after the concert, the the business have started in on 14th of November. It's going to be dissolved in that previous year itself, right? Now, how does the AO go about with respect to assessment of this particular AOP, right? So will he make the assessment for the income earned from 14th of November 2020 to 14th of Feb 2021 during AY 2021 itself, or whether the AO has got a discretion to tax income in AY 21-22? Well, none of the above or all of the above. Well, Shivani says all of the above. Are you sure all of the above? Vasudha says option B. Well, it is not option B. Well, a lot of you have not answered it, but yes, Shobha says it's option A. Well, it is indeed option A. Here, assessing officer doesn't have a discretion, friends. Since it is dissolved, it is getting dissolved after the concert. The assessing officer doesn't have a discretion to wait for the assessment year to commence. He would tax the income in the previous year itself, right? So it is option A for this particular situation, and not all of the above, because there is no discretion to the assessing officer here. We are talking of an AOP as well as BOI, right? Body of individual and association of person. Well, we'll see what it means, but for the timing, what we have dealt with is we've dealt with the assessment year, we've dealt with the previous year, we've dealt with the situation where where the income of the previous year is taxable in the previous year itself. That is what we call as accelerated assessment. What we now move on to is the definition of the term person, right? It is only if the person has a total income has got an income in the previous year, would the charging section apply, and therefore what who is a person for the purposes of the act. So now the definition of the person is contained in section 2 into bracket 31. 2 into bracket 31 provides for the definition of the term person. The charge under section 4 is on every person, right? So every person is going to be taxable under this act. However, when you look at the definition of the term person, it is an inclusive definition. You have got an inclusive definition. Section 2 into bracket 31 includes, so it says includes an individual, a, a Hindu undivided family, a company, a firm, association of person or body of individual, whether incorporated or not, a local authority, and every artificial juridical person not falling within any of the preceding sub clauses. So person is defined inclusively. What do I mean by that? When I define something inclusively, person would mean 1, 2, 3, 4, 5, 6, 7, and all other like that. Getting my point? So it is an expanding definition. It would depend on the general common usage of what a person means. So person includes this, and according to the trades and the customs, right? So person would include individual. We understand what an individual is, isn't it? An individual means um, males, females. So we are all individual human beings, right? All individuals, right? Similarly, we've got Hindu undivided family. Now, this is a very unique concept. This is a concept which is prevalent only in the country. In India, you won't find it anywhere else across the world. For to set things right, to set it on record, Hindu undivided family, it's not defined under that. What HUF mean is not defined anywhere. But you know, having regards to the Indian scenario, where we still have joint families in place, HUF is assessed as a separate tax unit. We see it is not a separate entity. Understand? Hindu undivided family, for all practical purposes, is not a separate legal entity, but it is a separate tax unit, right? So it is taxed separately. It is not a separate legal entity, but it is taxed separately, right? Company, yes, it is a distinct legal person, right? Company, we all get it, but HUF, you won't find it any across the world, and still, we have got it defined distinctly in the list of the person, meaning that an HUF would be a separate tax unit, taxed distinctly from an individual. So family income would be taxed separately, and the individual income would be taxed separately under the Income Tax Act. So this is a very unique thing in the Income Tax Act of the country, right? The HUF. Now HUF, what an HUF means, you need one Hindu, two a family, three which is undivided. Now what is an undivided family? Whether two people can make a family? The answer is yes. There should be at least two people to make a family. Now, out of those two people, one should be at least a male, right? So only at least one male member is required to form a family, right? And but then two members. So two members could make an undivided family. If there is only one single person, there is no family, right? So you need two individuals, out of which one should be male, and the family comes into place only if the male is a Hindu. Now, who is a Hindu? You got to go to the Hindu Succession Act, right? Where the definition of the term Hindu, you have to borrow the definition of Hindu from the Hindu Succession Act. So that is amply clear. Who is a Hindu, and once he's got an undivided family, it would be treated as a distinct tax unit. Now, with effect from 6th of September 2005, Even daughters are considered as co-partners in a Hindu undivided family. And in fact, recently in one of the judgments of the Delhi High Court, very interesting judgment. Um, a daughter can also be treated as karta of the family, because the eldest co-partner would be the karta of the family. So a daughter can also be a karta. That is different. But then, understand, for the time being, a Hindu undivided family is a separate tax unit, and that is only relevant in India. Across the world, you won't find such a status. Now, a lot of people ask me, how do you form a Hindu undivided family? How could how could you uh, incorporate a Hindu undivided family? Well, Hindu undivided family cannot be incorporated. It is a status. A Hindu undivided family is a status, and there is no formation as such for a Hindu undivided family. It is a status. Thereafter, you have got company. So a company would mean both the domestic company and the foreign company. A firm would mean a regular partnership firm under the Partnership Act 1932, as well as the Limited Liability Partnership Act and Limited Liability Partnership firm under the LLP Act of 2008. So whatever firm is incorporated under the LLP Act of 2008 or formed under the Indian Partnership Act 1932, both are distinctly covered in the definition of person. Thereafter, you've got association of person or body of individual. Now, association of person, there is one very important distinction between AOP and BOI. The most important distinction is association of person is an association of different persons. So it can be individual, HUF, company, firm. All of them can come together and form an association. However, body of individual is a conglomeration of only individuals. So it is like only individuals coming together to form a particular body, right? So when it is association of person, it is a separate tax unit. If they come together for a common purpose, if they are coming together to they join all the persons, different persons join together to form an association for a common purpose with a common objective, right? And then you have got association of person as a separate tax unit. So AOP is to be taxed distinctly, and the persons who have made that AOP would be taxed differently, right? So like co-heirs or co-legatees, right? Co-donees, they would be association of person, right? All the heirs of the deceased, they come together and run the business of the deceased, right? So that would be an AOP. However, as far as the body of individual is concerned, it can be formed with or without the objective of producing income. And like examples would be co-trustees. Let's say multiple individuals are made trustee of a particular property, right? Now, though that would be a body of individual, right? So association. I hope you understand the distinction between association of person and the body of individual. It may be incorporated or it may not be, right? So a public charitable trust is incorporated, right? But however, the red flags that we were discussing a couple of minutes ago, right, which was formed for a particular event, right, that was not incorporated. It may not be incorporated. So if it is not incorporated, yet it would be taxed as association of person. So whether it is incorporated or not, AOP is a AOP. Thereafter, local authority. So local authority is again a distinct tax unit. I hope you know what local authority is. So municipal corporation, cantonment board, all of them are local authorities, right? Wharf boards, right? So they are like local authority. Now, every artificial juridical person not falling within any of the preceding sub clauses. So as far as the person definition of person is concerned, this seventh item would cover most of the items of most of the uh, persons earning income or having a source of income. Every artificial juridical person. Now, this would take into its ambit, even deities or God for that matter. Like, say, for instance, all of you are aware that there are a lot of temples in the country where a lot of donation comes, and a lot of offering is made to God. Now, who is earning that income? Whether it is the pujari in the temple, right, or whether it is the god himself. Well, god or the deity is treated as artificial juridical person for the purposes of that. It is a different matter that uh, uh, religious trust or religious temples are exempted under the act by virtue of section 11, right? Section 11 provides for a exemption, but then yes, uh, it would come within the ambit of the or artificial juridical person. I'll discuss this in a little more detail, because one of the news that I came, just recently I read one of the news and I was very much interested of whether the income derived by that particular animal would be taxed. Let me just keep it in abeyance for the timing, but then let's see each of them one by one and the issues relating to each of them. Like individuals, whether a minor would be treated as individual and whether she would be liable. So here we've got minor, whether she would be liable to pay tax under the act. The answer is yes. For the purposes of the act, even a minor would be individual. A person with unsound mind, yes, he would still be a person classified as individual. So he may not be competent. He or she may not be competent to contract. You have all read the Indian Contract Act, Section 11 of the Indian Contract Act. They're not competent to contract. But as far as tax payment is concerned, yes, they would be treated as person for the purposes of the act. Similarly, in case of HUFs also, you can have multiple HUFs, right? Here, what you have is a big joint family. Now, in this big joint family, the eldest member would be the Karta. There are a few female members. Now, these are not co-partners. Female member, wife of son's wife, they're not co-partners. The children of the son of the Karta are the co-partners under the in this HUF, right? So children would be co-partners. They get the right from the birth, right? And however, these are the females are the members of the HUF. Even a daughter, a female, is could be a co-partner by virtue of birth. And there could be, this is one big joint family. However, what could happen? You could have only this small family also, right? So you've got one big family and one subset family here. So there could be two HUF. One is the big joint family in which he is the Karta, the eldest member, and the subset family or the child family here in which he would be the Karta. The eldest male member would be the Karta, right? So this is the HUF. Let's go to company. What is a company? So company is classified into two. We've got domestic company and foreign company. Now, domestic company would mean an Indian company. Indian company, domestic company is defined under section 2 into bracket 22A, section 2, clause 22A of that. It means domestic company is a Indian company or a company with arrangement for declaring and paying dividend within India out of the income chargeable to income tax, right? So company with an arrangement for declaring and paying dividend within the country out of the income chargeable to income tax would be a domestic company, or every Indian company is a domestic company. What is an Indian company? It is defined under section 2 into bracket 26A. So 2 clause 26A defines Indian company. to mean every company incorporated under the Companies Act 2013 or Companies Act 1956, the earlier Companies Act. So that would be an Indian company, provided if it has got the principal place of business in India. So domestic company would be an Indian company or a company with an arrangement of declaring and paying dividend within the country. Rest all of the other companies would be classified as foreign company. A company which is not a domestic company is a foreign company. Now, why do I need to classify company into domestic and foreign? The reason is foreign company, you have got a separate rate of tax. You have a distinct rate of tax. So you've got a 40% tax rate for foreign companies, and therefore it becomes important to actually distinguish between the Indian company and the foreign company, right? Now, so I hope you get the term company. Let's move on to AJP. In case of AJP, I read a particular news article and see here what it says. Angry over family feud, farmer wills part of his property to his pet dog, right? So what the farmer has done, he is parted of the property to his dog. Now, the income from that property, would it be taxable? Now, where does dog fit into the list of the person? Well, yes, Mansha, you're right. Daughters have got equal rights in the property of HUF, and in fact, they are now co-partner. They've been given the right of co-partner from that 5th of September 2005, 6th of September. Yes. So, do you think dog would be, would be covered by the definition of person? Yes. What do you think about it? Now, the news very, very interesting. Well, a few of them say that it is not taxable. However, Pritesh is saying that yes, it would be AJP. Well, apart from this story, I also recently came across a very interesting judgment of a Punjab and Haryana High Court, wherein it was stated that the entire animal kingdom, including avian and aquatic animals, are legal entities. So what that judgment pronounced was in respect of rights of the animal. So it was in respect of cruelty that happens with animal. Uh, there the court opined that all the animal kingdom has got a separate entity, and therefore even this dog would fall under the definition of person by virtue of every other juridical person. So every artificial juridical person would be taxable under this act. So we are not going to leave the dog also, right? So we've got a definition that is quite big enough to take into its ambit even the dog. We are not going to leave anybody, right? So it's very interesting as far as taxation is concerned. Who are you going to tax? Let's In fact, you're not going to leave anybody, not even a dog. Let's check out an MCQ, right? Here, as per the definition of section 2 into bracket 31, the following is not included in the definition of person. Who is not included into the definition of person? Yes. Who is not included in the definition of person? Gauri has a question. After marriage, whether a girl can become co-partner in her in-laws family? The answer is no. She's not a co-partner in the in-laws family. She is a co-partner in her own family where she has acquired the right by birth. So after marriage, if she moves on to another family, she would merely be a member there. So in our example also, where we met the Malhotras, the females were only the members, and it is not, they're not, um, these two were not co-partners. They were only the members of the HUF. Yes. So who is not included? Well, it is D. Yes, the central government. Perfect. So a lot of you have answered that well. A domestic company. We've just seen what a domestic company means. Whether it is only an Indian company, both Indian and the foreign company having branches in India, both Indian company and foreign company having business connection in India. We have yet to come to business connection. By the way, both Indian company and a foreign company which have made the prescribed arrangement for declaration and payment of dividend in India out of income chargeable to tax in India. Yes. So where do we go? Jomin has a very, very interesting query. So if the dog doesn't pay income tax, whether he's going to go to jail. Well, Jomin, the dog is not, he's not entitled to make the payment. It is the caretaker of the dog who would be the legal representative of that dog. Yes. A domestic company means whether it is only an Indian company or whether it is a Indian company and a foreign company. Well, a domestic company would all never be a foreign company, right? So a domestic company would mean an Indian company, but then a foreign company which are the prescribed arrangement for declaration and payment of dividend in India out of income chargeable to tax in India is also a domestic company. We've just seen um, we just saw this particular chart. Just a second. We just saw this particular chart wherein we have the classes of company, the company classified into domestic and foreign. With domestic company, it would mean Indian company and a company with arrangement for declaration of dividend within India. Right now, when I look at the question here, this question provides me for option D, where it is Indian company and a foreign company which have got arrangement for declaration and payment of dividend in India, right? And therefore, it is option D, which is the domestic company, uh, which would be falling within the meaning of domestic company under the provisions of the Act. So D is the correct answer. Let's move on to the next question. Which of the following are artificial juridical person? Well, the artificial juridical person, in this case, river, idol, deities, university, all of them are artificial juridical person if they are, they are earning any of the income, right? They are to be represented by these juridical person would have to be represented by an individual, right? So idols and deities generally it is the pujari or the trustee of that idol who would be taxable, who would be made taxable, right? All of them are covered by the definition of the term artificial juridical person. Even the bar council, the bar council have been treated as artificial juridical person. So it is D, all of the above. Vijay, Vijay, it is D. It is all of the above, right? Anybody, all of them, whoever is earning income now. In India, we give special importance to rivers, right? And therefore, if at all there is some earning in the name of the river, even that would be, taxable under the act, and the river would be an artificial juridical person. So it could then. Yes, cantonment board. Whether cantonment board is a HUF, whether it is a Hindu undivided family, no. Whether it's a company, no. Right? Whether it is a local authority, yes, it is a local authority. Local authority is not defined under this act. However, Section 3 into bracket 31 of the General Clauses Act defines local authority, which by and large mean that this local authority would have a particular jurisdiction, and over that jurisdiction it has got certain statutory functions to be performed. So the municipal corporation, the municipalities, gram panchayats, all of them are local authority. Even the cantonment board is a local authority. Then let's move on. Okay, so what we have seen is the assessment year, the previous year. Now we move on to the definition of the term income. But before we move on to income, I've got a few requests for a short little break. Take a short little break of 5 minutes, and come back again. All right. Jaisa, should we go live? Okay, great. All right. So, well, income, it's very important to understand what income is, because unless and until we understand what the income is, we won't know what is going to be taxed under the act. Now, the definition of income is an inclusive definition. So, like the definition of person we saw was an inclusive definition. It doesn't mean you don't have a definitive meaning to the term income. It is an inclusive definition. So unlike the assessment year, which is which is defined particularly, there is no inclusiveness. It is a fixed definition. Assessment year means, right? So it is not inclusive. It is definitive meaning that is assigned to the term assessment year. However, when you look at the definition of person, it includes it. You don't have a meaning for that particular term under the Income Tax Act, but it includes the following, right? So you got to draw the meaning according to the regular usage and customs of the trade, commerce. So similar to that, you have the definition of the term income, which is also inclusive and not exhaustive. you know it is not defined. It doesn't give a The act doesn't give a definitive meaning to the term income, and therefore it is an inclusive definition. Such a definition, it doesn't confine the scope of income, but it leaves room for more inclusion. You can just keep on adding up. So under the act, the definition is so huge. The income is defined in a manner which is so huge that it takes into its ambit even those items of income which we do not understand, or which we do not in regular customs we don't treat it as income. So from the accountant's perspective, you might have a particular notion about income, but that perspective is not going to hold true completely as far as the Income Tax Act is concerned. For the purposes of Income Tax Act, you got to take into consideration the definition of the term income as provided under section 2 into bracket 24. However, you know, one it has been defined to include a particular a few of those items which are not generally income, but those items which have been kept out of the definition, right? Generally, the capital receipts which have been kept out of the definition of income would still remain tax free under the act. So, in fact, trust me, over the years, I've seen that most of the items of capital receipt have been gradually brought into tax. Uh, Anything that was free earlier is now being taxed under the Income Tax Act, and it is done very, very aggressively. So most of the items of the capital receipt have been brought under the ambit of section 2 into bracket 24 and the other charging provisions under the act. However, having said this, there are still a few capital receipts which are not taxable. The thumb rule is, so unless and until a capital receipt is specifically included in the definition of the term income, would not be taxable under that. So the thumb rule is capital receipt, unless and until specifically taxable, is not taxable, is exempt. So there should be a specific provision to tax a capital receipt. However, as far as the revenue receipts are concerned, they would always be made taxable. Let me show you the definition of the, let us first discuss 2 into bracket 24, and then we come in, then we see the three classes where the broad provision of section 2 into 24 operates. So let me first share the provision. I'll just stop my screen share for a short while. I'll just move to the module. So when you look at the definition of the term income, you find that 2 into bracket 24 specifically includes profits and gains, dividends, voluntary contribution. Now, profits and gains, yes, it's fairly understandable that profits and gains would be income of a particular person. Dividends are income, so it is fairly logical. When it comes down to voluntary contribution received by trust or institution, created only for wholly or partly for charitable or religious purposes, here you fail to understand. Voluntary contribution by itself is not income because they are voluntary. There is no consideration flowing by the recipient of that particular amount. So like any temple donation that you make, there's no consideration for that temple donation, but yet it is treated as income. Getting my point? So it is treated as income despite being voluntary because it is specifically included in the definition of the term income. Thereafter, perquisite or profit in lieu of salary, right? It is again made taxable. So salary, yes, it is my revenue receipt. All that you receive incidental to the salary is again treated as income. So special allowance received by an assessee, right, would be income of that particular assessee. So you have got these different items of revenue receipt, but then apart from that, you have got a few items which necessarily do not mean income, like the capital gains, any capital gain chargeable under section 45. Now this arises out of sale of capital asset. Now selling of a capital asset would by itself would not lead to revenue source of income, but yet it is taxable under the act. Similarly, mutual insurance company or a cooperative society, mutual concerns, they've been made, some of the mutual concerns are specifically made taxable under the act, right? So, not all mutual concerns, by the way. So, clubs where there is a oneness of identity between the members and the club, well, income or surplus arising from such oneness is not taxable because of the mutuality involved. But then when it is a cooperative society or a mutual insurance company, the surpluses would be taxable because specifically included in the definition of the term income. Winning from lotteries, crossword puzzles, races, horse races, right, gambling, betting. Now these are casual sources of income. These are wagering agreements. You have you have seen the contract act, right? So these are wagers. Basically, they're not income. However, they're not regular sources of income. However, and they are casual receipts or windfall gains. Now, these are specifically included in the definition of the term income, right? So, therefore, it is income. Otherwise, from our accountant's perspective, probably we treat only the regular sources of income as income to be taken to the income statement. Then. So contribution of the employee to the provident fund specifically included. Amount received under keyman's insurance policy. Now that is something we are going to see when we deal with exempt income, specifically section 1010D, where we see the keyman's insurance policy. But any amount that you receive on insurance, maturity of an insurance policy would be capital receipt. However, specifically treated as income under the act, right? So similarly, you've got agreement, any amount that you receive on out of agreement in restraint of trade. Well, that is that is again treated as income. Amount received for not doing something. So to do something, if you receive something, that is your income. But for not doing something, you still receive something, that is treated as income under the act. Now, not only this, there are certain notional income. Like there is no income at all, right? There is just a change in classification. Yet it would be treated as income. Like the item that you see on your screen, fair market value of inventory, which is converted into or treated as capital asset, right? Mere conversion of inventory into capital asset, where does the income come from? It is like by taking money out of one of my pocket, putting it into another, and I say, no, you have earned income. Well, but then as far as the income tax act is concerned, you've got to go by the strict meaning or whatever is written in the income tax act, right? You cannot supply anything extra, you cannot derive, you just cannot remove anything. If it is said so that this is income, it is income. So fair market value of inventory which is converted into capital asset. So you're going to see this while you deal with the profits and gains of business or profession in the subsequent lecture. What I want to emphasize here is only the fact that as far as the Income Tax Act is concerned, the definition of term income is more broader than what we understand from an accountant's perspective. Any consideration received for issue of shares. Now, issue of shares, each one of us is going to agree to the fact that amount received on issue of share is a capital receipt and it is not income. However, section 56 to 7b specifically says that issue of shares above fair market value by a closely held company would amount to income if the consideration is above the fair market value. So that is something you're going to deal with while you learn income from other sources. Forfeiture of advances specifically treated as income. So these are very, very innovative items which have been added off late. As they saw that people are trying to find out ways of earning capital receipt or escaping tax by way of capital receipts. uh, this this definition of income was enlarged from time to time. So it has been enlarged on multiple occasions. These are all additions in last 10 years, 15 years, right? Or it has been ever expanding since then. Anything which they find is exempt, or people are trying to exploit a particular provision, particular item, they immediately put it into the act and make it taxable. So the definition of income is inclusive and it is ever growing. So assistance in form of subsidy. Now, subsidy grant by itself is not income, but then it is given by the state government or central government to provide a boost to a particular industry, particular assessee, to a particular sector, right? But then and it is again, there is a condition attached to the subsidy, but yet it is in the nature of help which the central government is giving to the assessee, but then treated as income, right? So these are the broad items of income which are covered by section 2 into bracket 24 of the act. And you would understand that this is really a quite a enlarged definition of the term income. Let's check out how you could just take a particular this entire definition, classified into three broad categories. We'll just classify it into three broad categories. I'll just stop the screen share and we'll go back to our original. Yes. So you have the three categories here as far the definition of term income goes. You've got the revenue receipt, you've got capital receipt, and you've got, other receipts, which are neither capital nor revenue, or, gratuitous payment, which are again treated as income. So profits and gains, dividends, perquisite, allowances, provident fund contribution, these are all revenue in nature. We understand regularity, there is a regularity of payment. There is a direct nexus between the work that you do and the consideration that you receive. However, sale of capital asset may not be my business income, or I don't carry on the business of selling my capital asset, but then yet capital gains is something that is going to be taxed as income here. Key man's insurance policy, issue of shares exceeding fair market value, forfeiture of advances, these are all capital receipts which are specifically made taxable. Now here it is important to understand therefore the distinction between revenue and capital. What is the distinction between revenue and capital? Well, what do you see here, friends? What do you see here? Here, what you see is a tree, isn't it? You have a tree here. And fortunately, it's a apple tree and got apples. Now, the best way to distinguish between revenue receipt and capital receipt, the first and the foremost thing is the regularity. Now it is not just mere regularity, it is one of the factors, right? Not always you should have a regular source of income, right? Now a mango tree could take 10 years, to have mangoes on that tree. Now, it does not mean there is regularity, but then, you have a tree in place, and out of which you are getting some fruits which are of a regular nature. Right now, this sale of apple by itself, whatever you receive out of the sale of the apple would be treated as revenue receipt. However, what happens is, one day you have a woodcutter. You know, do you see him? I don't know whether it's visible on the screen, but then you have a woodcutter. And what he does, he cuts down the entire tree. Right now, apples, yes, were revenue received. Now, what happens is you've got you've got a tree which is cut down, and now this is going to be sold, right? Now, whatever you earn out of selling of the source of revenue receipt, means the apples, now there would be no further apples, right? So whatever you gain out of the sale of the entire source would be capital in nature. So the best way to distinguish between the revenue receipt and the capital receipt would be whether the amount that you have received is out of the source. If you're cutting down the entire source, it is capital in nature. However, if you're getting something regularly out of some labor, right, out of some out of your own efforts, that is going to be revenue receipt. So revenue receipt by default is taxable, and capital receipt, by default exempt, unless it is specifically made taxable. So thumb rule is revenue receipt is taxable unless specifically exempted, and capital receipt is is always exempt unless specifically made taxable. However, I have already shown you the definition of the term income. As we progress through our lectures, you will come to know that most of the capital receipts have been brought into the ambit of various charging provisions, various small charging provisions, specific charging provisions of different heads of income. But then, the distinction of capital and revenue still has, some point, because not all capital receipts are taxable. Do you get this? So the capital and the revenue. Now, sometimes there is casual receipt. Now, casual receipt, you may say that it is not income. However, as far as the Income Tax Act is concerned, they do not make any distinction between casual receipt or revenue receipt. If you earn income, even if it is casual income, it would be made taxable. So winning from lotteries, etc., windfall gains, they are all taxable. So this guy got to pay tax. In fact, even on illegal income, even on illegal income, if at all a particular person is earning income, uh, uh, if a particular person is earning income out of smuggling, now that person would also be taxable under the act, right, on his illegal income. So the famous saying of Al Capone, that US gangster, he once said, Al Capone, he once said that there can't be legal tax on illegal income. However, Income Tax Act again doesn't make any distinction between illegal income and legal income. Everything is going to be taxed. Even if it is illegal, it is going to be taxed under the act. So regular income, certainly it is going to be taxed, but even the casual income, so person earning profits and gains out of business, out of profession, it is going to be taxed. Illegal income, legal income, there is no color to income as far as the Income Tax Act is concerned. Casual income would be again taxable. So that is how the definition of term income is important. However, what I wanted to emphasize here is that it is a inclusive definition, and therefore you have to derive the meaning not only from what is given in the act, but also the common parlance, the use, normal use, right? Let's move to the next concept. I hope you get it. Now the rates of taxes. So we all know now, we have been dealing with section 4. In section 4 we said that where a central act enacts that income tax shall be charged for any assessment year at any rates. So we know that the rates of the income tax uh, are provided into the Finance Act. So we have to check the rates now, right? And the income of the previous year is going to be taxed in the assessment year. So let us check the rates of income tax. You look at the rates, you find that there are different rates for different categories of person. So not all of them are taxed at a particular, at one rate. It is unlike that, unlike a lot of countries which tax their citizens at one flat rate. Here we do not have a flat rate. The reason is, in India, we've got a progressive tax structure because of the disparity amongst the citizens. There is so wide ranging disparity, and therefore we have a progressive tax structure. One who earns less pays less. Simple rule. The rule is quite simple. One who earns less is going to pay less, and therefore, in case of individuals, HUF, AOP, body of individual, and artificial juridical person, we've got a progressive tax structure. So all individuals now, from our examination perspective, it is generally the individuals which would be important, right? As far as the tax calculation is concerned, it is the individuals HUF, right? That is going to make our tax calculation, right? Most of our tax calculation. So we don't have companies. Assessment of companies is not there in your syllabus, and therefore let us focus first on the individual taxation. When you look at the individuals up to 2.5 lakh rupees, there is no tax, nil rate of tax, right? So that is the basic exemption limit. We call it as the basic exemption limit. Then we've got, just a second, give me a second. Then we've got some exceeding 2.5 lakh rupees, but does not exceed 5 lakh rupees. The rate is 5% on an amount exceeding 2.5 lakh rupees. So 5% is the rate. This is my first slab. First slab is, up to 2.5 lakh rupees, nil rate of tax. Second slab, 2.5 lakh rupees to 5 lakh rupees of total income. Total income. We are talking of, we've just discussed income under section 2 into bracket 24. We did not discuss total income. Total income have not been discussed by us. But for the timing, understand it is 2.5 lakh rupees of total income. If your income is up to 2.5 lakh rupees, no tax got to be paid. That's the basic exemption limit. If it exceeds 2.5 lakh rupees, you end up paying 5%. You end up paying 5%. Then if it exceeds 5 lakh rupees but does not exceed 10 lakh rupees. So 2.5 lakh, exceeding 2.5 lakh rupees up to 5 lakh rupees, 5% on an amount exceeding 2.5 lakh rupees, exceeds 5 lakh but does not exceed 10 lakh, 12,500 plus 20% of the total income exceeding 5 lakh rupees. And whether total income exceeds 10 lakh rupees, you've got 1,12,500 plus 30% of the total income exceeding 10 lakh rupees. Now these are the slab rates, different slab rates. Why 12,500? Simple, 2.5 lakh rupees minus 5 lakhs minus 2.5 lakh rupees is 2.5 lakhs. 5% of 2.5 lakh rupees would be 12,500. So a person who is earning more than 5 lakhs would always be earning, would always be required to pay minimum 12,500, right? And therefore 12,500 plus 20% of the difference. So that is how it is computed. Now, in case of individuals who are aged 60 or above, we have got a relaxed limit. The relaxed limit is that of, I'll just show it to you. The relaxed limit, the basic exemption is increased from 2.5 lakh rupees to 3 lakh rupees. So this gentleman who is aged 60 or above would be taxed at, taxed on income above rupees 3 lakh. So you've got income up to rupees 3 lakh, no tax got to be levied. Provided this basic exemption is only in case of resident assessee who have acquired the age of 60 or more at any time during the previous year, right? So at any time, it could be on the last day of the previous year. Even if it is last day of the previous year, if the person is 60 during that previous year, he is going to be assessed at a higher basic exemption limit. He's going to get the benefit of higher basic exemption limit, provided he's a resident 60-year-old assessee. So for 60-year-old, you've got 3 lakh rupees of basic exemption, 3 to 5 lakhs, 5%, 5 to 10 lakh, it would be 10,000 plus 20%. So earlier you saw 12,500, now you have got 10,000. So additionally, what he is getting is 2,500 of benefit. Now, then let's move to a category that exists in a very small number, and that is the super senior citizen. We've been talking of senior citizen here who is 60 or more. There is a new category, relatively new category, and that is 80 or more. Now, that category probably doesn't even exist. I don't know whether it does exist. And if it does exist, it might so exist, but then it is very unlikely that they need the basic exemption of 5 lakhs. Generally, beyond the age of 80, you're not concerned with what income you're earning. But then exemption is given to them, the basic exemption up to rupees 5 lakhs. Up to rupees 5 lakh, no tax. Beyond 5 lakhs to 10 lakhs, you have got the regular 20% slab, and beyond 10 lakhs, you've got the regular 30% slab. So he ends up saving 12,500. This, a resident super senior citizen that is aged 80 or more at any time during the previous year. So it is at any time during the previous year. I'm emphasizing it again and again. Even if it is last day of the previous year, yet it would be, he would be covered by the basic exemption of 5 lakhs. Then let's move on to the surcharges. Now, if it comes down to, drills down to a question on calculation of tax, mere calculation of tax, I think, understanding surcharge is extremely important. Because, anybody who wants to test your knowledge as far as computation of tax is concerned would not do it without, judging you for whether you understand what surcharge is. So let's see how surcharge is levied on individuals. So first, we are focusing only on taxation of individual. We've got 3 categories. One is normal resident, normal individual. 2 is resident senior citizen. 3 resident super senior citizen. Then you go to the surcharge. Surcharge got to be paid by those assessee who earn more, right? The logic of imposing surcharge is that those who are earning more should pay more, right? Quite equitable, isn't it? One who is earning more should pay more, and therefore those individuals who are earning more than 50 lakh rupees of total income. So if their total income is exceeding 50 lakhs, the person would have to pay, the individual would have to pay 10% as surcharge. So it is individual, HUF, AOP, all of them are put into the same basket. So individual, HUF is nothing but a group of individual, and therefore HUF, AOP, BOI, all of them are put into the same basket. So surcharge would be applicable in all the cases if their income exceeds 50 lakhs. 10% surcharge got to be paid. So 10% surcharge would mean 10% of 30%. 30% is the highest slab rate. So beyond 50 lakh rupees, you are paying not only this 30%, but what you are also paying is additional 10% surcharge on this 30%. So surcharge is always levied on the amount of tax. So it is not 30 plus 10, 40%. It is 33% therefore. And on this 33%, you also pay 4% higher health and education cess. You are paying health and education cess at the rate of 4% on this 33%. So the effective tax rate is 34.32%. Then, whether total income exceeds 1 crore. So if the total income is exceeding 1 crore, you end up paying 15% surcharge. So 10% surcharge for those who are earning 50 lakh rupees or more. For those who are earning 1 crore or more, we are paying 15%. For those earning more than 2 crores, the rate of surcharge is 25%. And for those who are earning 5 crores, the rate of surcharge is huge, 37%, right? So this, when you look at the rates of surcharge, it starts with a modest 10% and ends at 37%. So we've got 4 slabs of surcharges, different slabs of surcharges. So 5 crore rupees or more, if you're earning, you end up paying 37% in surcharge, which roughly amounts to 11.10%. It exactly amounts to 11.10% of the tax. That is 30% into 37% would be 11.10%. So the effective tax rate for those who are earning more than 5 crore would be 42.744%, right, on income exceeding 5 crores. Now, having given you the different limits of the surcharge, what they've done is they've made one specific provision, and that says that income accessible under section 111A, 112A, or 115AD, or dividend income, the surcharge shall not exceed 15%. So in respect of specified securities where income is earned from equity shares, right? Long-term gain or short-term gain on equity shares. The surcharge is kept at a moderate 15%. The reason being, you have to promote the investment into equity market, and therefore, what they've done is, irrespective of the fact that a individual would have earned probably more than 5 crores, if the income is out of short-term capital gain or long-term capital gain on securities or dividend income, the surcharge would never be exceeding rupees 15%. Never exceed 15%, not rupees, never exceed 15%. I'll just cover all of these scenarios by way of this table so that you understand it better. Let's understand. So I hope you get the logic of imposing surcharge. The imposition of surcharge is fairly logical. Those who earn more should pay more, and therefore we've got surcharge to the high earning group, right? It is the high earning group who is levied with the surcharges, and not the person into the middle class or the lower middle class of the society. They are not subjected to surcharge. It is only the high HNIs, the high net worth individuals, who would be subjected to surcharge. Let's take this, different scenes of surcharge. The first scene 1, right? You've got dividend income 10%, short-term capital gain 20%. Sorry. Dividend income 10 lakhs, short-term capital gain 20 lakhs, long-term capital gain 25 lakhs, and other income 40 lakhs. Now here, what is my total income? What is my total income here? $10 plus 20 plus 25 is 55 and 95 lakh rupees. So it is like 95 lakh rupees. Yes, do you all agree? 95 lakh rupees. Now that is exceeding rupees 50 lakhs, but not exceeding 1 lakh. So it is between 50 lakhs and 1 crore. Sorry, 50 lakhs and 1 crore. It does not exceed 1 crore, but it exceeds 50 lakhs. The rate is 10%. So I'll stick to 10% of surcharge here, right? We'll charge 10% of surcharge because the income is above 50 lakhs but below 1 crore. Now, having regards to the different rates of surcharge, can you tell me what would be the surcharge for scene 2? For scene 2, the scenario 2, what is the rate of surcharge? Yes, what is the rate of surcharge for the second scenario? Dividend income 10 lakhs, short-term capital gain 60 lakhs, long-term capital gain 65 lakhs, and other income 50 lakhs. Yeah, so yes, um, Venkatesh, perfect. You make great point here. He says it's 185 lakhs or 1.85 crores. 1.85 crores is my total income. So it exceeds, sorry, 1.85 crore is my total income. It does exceed 120, 130, 180. Okay, fine. 125. So 185, 1.85 crores, it does exceed 1 crore rupees, but it is less than 2 crores, right? It does not exceed 2 crores, it exceeds 1 crore, and therefore the rate of surcharge would be 15%, right? It does not exceed 2 crore. Look at this. It would go into the second slab alone. Perfect. So Anirudh, yes, you're right. So surcharges, yes, 15%. Aditi, why do you think it is 25%? It is only 1.85 crore. It does not exceed. So where the total income exceeds 2 crores, only then you have 25% of surcharge. Here it is not exceeding 2 crores, and therefore Aditi, just reconsider 25%. Now if you charge 25% to somebody who is entitled to 15%, the client is not going to come back. Then let's go to the scenario 3. Now in scenario 3, it is quite interesting. Let me tell you. The other income is 3 crore rupees. So other income itself is 3 crores. So immediately what you do is you know now that it is exceeding 2 crores. So therefore 25%. Let's take a sum of it. 3 crores and 55 and 54 lakh rupees. So that is 109 and 60. That would be, 4 4.69 crores. So it is also less than 5 crores. But then, therefore, you may conclude that it is 25% of applicable surcharge on the tax. However, there is a catch here. You know, as far as those income which is covered by, 111A, 112A and dividend, this amount of income would the tax payable on this amount of income would attract only 15% surcharge. So it would attract only 15% of surcharge. So 1.69 crores, the tax on 1.69 crores, you end up paying only 15% surcharge on the amount of tax that you pay. For rest of the 3 crores, you would have to pay 25% surcharge. Do you get my point here? So like on 60 lakhs plus 54 lakh plus 55 lakhs, that is 1.69 crores. Whatever the tax liability is, you have got different rate of taxes for 111A and 112A. 112A, you've got a special rate of tax. Whatever tax is computed, you got to pay 15% on this maximum. So, even if the surcharge applicable rate is 25%, yet you'll have to pay 15%. So of the total amount of income, you'll have to exclude these three, right? And thereafter apply 25% surcharge on the balance income, which is that of 3 crores. Tell me, how do you charge, surcharge for scenario 4? Well, yes, Suresh, fantastic. It is indeed 25% on other income and 15% on dividend and LTCG and STCG. Now, only those STCG items of STCG and LTCG which are covered by 111A and 112A. Now, what is that 111A and 112A, you'll get to know as we deal with capital gains. But for the timing, it is the equity shares which are subjected to STT, the securities transaction tax, and the the units of equity oriented fund and business trust, that is covered by 112A and 1111A. Dividend, I don't think you need to be explained about dividend. All right, Mansha, you're right. 111A, 112A, 15%, remaining 25%. That it was for scene 3. How about scene 4? Joman gives the answer. Kiran, yes, fantastic. Both Jomin and Kiran, you're right. On 6 crores, you pay 37%. See, on this 6 crores, which exceeds 5 crores, you end up paying 37%. And on the balance 1.16 or 1.69 crores, you pay at the rate of 15%. Now, scene 5 is a little special. Let's go to scene 5. Yes, Charu, you're right. 37% on 6 crores and 15% on dividend and 111A and 112A. Gauri is asking, can I show my business income in the name of my father, who's a super senior citizen? Well, Gauri, that would be illegal to do because you have to give your income in your return of income. If your father is not earning that income, how could you, show it in the name? Just showing it in the name of somebody else is not going to help. So like legally, it is only the Portuguese civil code where you have got, now you can divide the income into two between the husband and the wife in equal proportion. So yes, it is 4.69. So here the income would be 7.69 crores, and out of which 6 crores would attract 37% surcharge, and the rest of them would attract only 15% surcharge. Further, the scene 5 is concerned, it's quite different, because the total income here is exceeding 2 crores. Total income here is excluding 2 crores, and therefore special provision have been made for such a scenario. When the income exceeds 2 crores, in that case, you got to exclude the income, not in other cases. Only here, if the income, uh, including the income from dividend 111A and 112A exceeds 2 crore, then on the amount of dividend income or the short-term capital gain or the long-term capital gain, you're going to pay 15%. And on rest of it also, you're going to pay 15%. So I'm not going to pay 25% on 1.10 crores. The reason being, it exceeds 2 crore rupees. The other income together with the special income exceeds 2 crore rupees. However, the other income is below rupees 2 crores. And therefore, you end up paying 15% on the entire set of income. You get it? The scene 4. Sorry, scene 5. Yes. Yes, Venkatesh, you're right. Scene 5 entirely, subjected to 15% surcharge. The reason being, even if the total income exceeds 2 crore, yet the other income, that is not the special one, does not exceed 2 crores, and therefore you end up paying only 15% on all of the items of the income. Then you've got rebate under section 87A up to the extent of 12,500. You have a rebate to the extent of 12,500 available only for resident individuals. Remember this, resident individual. It is not available to HUF, AOP, BOI, etc. It is available only to resident individual, and that to those having income, total income up to rupees 5 lakh. So if you have got even 5 lakh one, right, 5 lakh one as your income, theoretically not possible, but 5 lakh 10, even if 5 lakh 10 is your income, yet you do not get a rebate of 12,500 under 87A, right? So 87A is applicable only and only if you have got an income up to rupees 5 lakhs. And also, the income from long-term capital gain under section 112A got to be included while you calculate this 5 lakhs. So this is something we deal with while we take up chapter 8, right, of your module, right? But for the time being, understand 87A rebate is available for those individuals, resident individuals, earning income up to rupees 5 lakhs. Then, so this is the normal rate of tax available for individual. Apart from the normal rate of tax, this particular Finance Act of 2020 brought in the alternative tax regime. So now you have got one more thing to deal with just because of this particular provision. And trust me, since it's a new provision, probably it is also it may be important from the examination perspective, and you might get a problem on the on the alternative tax regime, comparison of tax liability between the normal tax regime and the alternative tax regime, and making a decision. See, making decision, whenever you're making a decision, so let's say you're making a cost decision, or you're making a decision for of relating to financial management. Taxation is one very important component. You have to take into account the amount of taxes that you're going to pay because of taking a particular decision, or the amount of tax saving that you're going to make because of a particular decision. And therefore understanding taxation is extremely important. I've seen students who say taxation could be really, it could be really brutal at times. Provisions of tax, we don't remember. Why do we need to learn so much of chaos? It is one of the very difficult things which a lot of people find. In fact, Albert Einstein, the famous scientist, he said once that the hardest thing on the planet is probably learning taxation or income tax. So if he finds that taxation is difficult, so be it. We take his take his statement on face value. But from our perspective, to make ourselves valuable, to make ourselves useful, you need to know the tax structure of the country, because for all practical decision making purposes, you will need the tax picture in your you need the tax angle. Then oh, okay, all right, okay. So therefore you have got the alternative tax regime, which is like 2.5 lakh rupees nil rate of tax, 2.5 lakh rupees to 5 lakhs 5%, 5 lakhs to 7.5 lakh rupees 10%, 7.5 lakh rupees to 10 lakhs 15%. It gradually goes on increasing. Now this is something again we deal with in chapter 8, right, comparing both the tax regime. Then let's move on to the uh, concept of marginal relief. Now what happens is government gives from one hand and takes from. Okay, okay, all right. Oh, so okay, okay, all right. Sorry. All right, friends, we take this up into the next lecture, right? For first 15 minutes, I'll cover the basics. I'll cover the very important marginal relief. We'll take up a problem on marginal relief, and then what we do is we take up the residential status. So in our next lecture, we're not only taking up residential status, but we are also we are also taking up the basic concepts, and then thereafter we'll move to the residential status. Thank you so much, friends, for your patience. I'll also try and answer the queries, which I've already answered some of them. I'll also try and answer the other queries. Thank you so much for being with me.